There's a lot being talked about equities, particularly as interest rates rise. Give us a sense where you are on equities right now as an investment. And you're not a trader. You do it over the medium and longer term.
We're not traders, and I've always said to everybody that market timing is for fools. I think every smart investor, successful investor, has pretty much said that. But of course, we do have opinions about the equity markets, and at the margin, we do make tactical tweaks and shifts to try to accommodate our view. And I would say that we have been very, very cautious about equities for some months now. Our equity exposure is down to the lowest levels it's been in our 12 or 13 years of existence, and we remain cautious, and interest rates are the biggest factor in that decision.
So just to take us through exactly how higher interest rates, which we're having not just in the United States, but almost globally at this point, how does it express itself in the value of the equities? Is that a matter of the slowdown in the economy overall, less demand for business? Is it a matter of valuations? How does it feed through to equities?
Certainly there are effects on the economy overall, and one needs to think about it. But my observation over, 40 years or so of watching equity markets is that they are keenly attuned to interest rates as a more direct transmission mechanism to equity prices, simply because interest rates are our discount rate on future cash flows. And it's not a coincidence that you've had the so-called unprofitable tech with the longest dating cash flows suffering the worst in this downdraft that is interest rate related, in my opinion, and some of the more near-term cash flow producing companies suffering less. I think there's a very, very direct correlation between the investment opportunity in fixed income or in interest rates versus in equities.
That suggests, perhaps, that some equities might make more sense than other equities. That is to say, those that are generating real profits today, cash today, may be a safer bet than those where it's really in the out years.
In terms of this factor, there's no question about it. And again, you can see it in the numbers over the last 9 months or so since the equity markets really started to roll over, which is the fact that longer dated cash flows, the further out you get, biotech, startups, growth companies have been hit the worst. The NASDAQ is down a lot more than the S&P, not a coincidence.
But you say have been hit the worst. There are those who really are fans of growth stocks who say, you know what, they've already taken the hit. That what happens actually when you go into a slowdown or recession, they take the hit up front, but then they come out of it faster and better.
Well, I'd like to see their evidence in support of that. And again, if you're talking about an economic slowdown, we could have that conversation. That may come out at a different place. If you're talking about a situation in which there's no evidence at all that we're at the end of an interest rate cycle, then I would push back. And in fact, if you look at the market as a whole, I believe it's true that the market has never really turned upward until the Fed has been done tightening. And again, there's no evidence the Fed is nearly done tightening.
So the Fed has been pretty explicit. They're going to keep tightening for quite a while. Do you have any projections? As you think about your investments, do you try to have any sense of how long that might be and, frankly, even what the terminal rate might be?
Well, we think about it more in terms of over-under. If you look at the market, the credit markets have been wildly behind the curve in predicting. The Fed's been behind the curve, and the credit markets have been behind the Fed in terms of their interest rate expectations. And so if you basically say, okay, well, the equity markets are taking their cue from the credit markets, you can see why we had this sort of mini bull run, if you want to even call it that, this summer, when it looked like maybe interest rates were starting to plateau or something like that. But we don't believe the credit markets are right. We think the credit markets are and have been wrong about this, and therefore, we think the equity markets, therefore, are mispriced relative to what is likely to occur, even assuming the Fed follows through on what they say they're going to do, let alone if they end up having to do more.
That all suggests that equity is probably not the place to be right at the moment. At the same time, people have money they want to invest. You have money you're responsible for investing. If not equities, where? Does that mean you go into fixed income?
No, well, certainly not long duration fixed income. If you agree with what I'm saying, which is that we're on the bearish side in terms of the interest rate cycle, then long dated fixed income, even starting at the 10-year or the 5-year, is not where you want to be. You want to be in something that looks more like cash. And as the Fed raises interest rates, obviously you can earn more on cash. People say to me, yes, but I can't earn the rate of inflation. Well, I get that. You know, I'd like to earn that too, but I'd rather not earn the rate of inflation than actually lose money, and that's sort of your alternative.
Things that look more like cash. What about things that look more like equities? Some people think that some of the high yield, particularly shorter duration, they perform more like equities. Is that more attractive right now? Because some of those yields are pretty high.
Some of those yields are pretty high, but again, you have to say to yourself, where could they go from here? Either because the tightening cycle proves worse than we thought, or because the market is mispricing them relative to what actually is going to happen. I think I don't think you can simply. I think what you're driving at with some of these questions is, well, just because something's gone down X%, doesn't that make it cheap? And the answer is no, that doesn't make it cheap. It makes it less expensive than it was before that happened, but doesn't mean it's cheap. I think look, we remain constructive, bullish, whatever you want to call it, on things in the commodity sector, the energy sector. We think that there's still a fair amount of demand pressure there. There is demand destruction going on, but there's still also a lot of pent-up demand that is being expressed. But beyond that, I think our view would be to be cautious. As I said, we're at our lowest equity or risk exposure that we've been in 12 or 13 years.
Let me come back to energy. I suspect I know the answer to this question, but the traditional energy has been doing rather well recently. Obviously, there's a lot of demand for it, a lot of crises, geopolitical crises. At the same time, there are alternatives like renewables. Now, those might be attractive. There's a lot of money being put by the U.S. government and others into renewables. But do you hesitate on things like that because of the discount factor you referred to earlier with the increased interest rates?
That's a great question. First, in the public market, we haven't seen much, and we don't invest directly in stocks, as you know, typically through managers, but we haven't also seen our managers do that much in public market renewables. We have become much more active in private market renewables because we are starting to bend that cost curve is starting to bend. And they are becoming more economic than they were a couple of years ago. The government programs help a lot. It's interesting to see investments that we've said no to before they passed the bill coming back after the bill with a different set of tax regime around it, and that makes these things work. And so actually for the first time, we are really seeing on the private side renewable investments that actually pencil out and make sense as an investment, not just as a policy tool.
I'll say that is interesting. In the past, you've not been there.
I've not been there.
That's a different place.
Yes, the curves are starting to cross. The government is helping, and you are starting to see. And of course, as conventional energy prices go up, which is not something that the advocates of climate change always appreciate, it actually makes the renewables more attractive and more investable.
So you mentioned the government there a couple of times. You know the government terribly well. You spent a fair amount of time in Washington. We've got midterms coming up. We've got a presidential election. Do you take that into account in any way, shape, or form, the political risk issue about what that could mean for investors?
No, honestly, not really, because first of all, I'm not smart enough to know what's going to happen in November, and then you're putting bets on top of bets on top of bets, and your probability of actually doing something smart is wrong. I would say that right before 2020, we did make some tactical shifts because of a view we had about how the election might come out, but that's a rare event for us. It's just not. That's too many degrees of separation for it to really work, I think, as an investment tool.
So as you look at the portfolio that you manage and the managers that you manage for that portfolio, what's the biggest risk, upside and downside, you look at right now?
Well, the biggest risk, is I think I've made clear, is in my mind, is interest rates. Obviously, as you implied in your opening question, that does have a feedback effect on the real economy, and as you've also noted, earnings expectations are coming down. They've been being ratcheted down regularly, and I think the analysts were way ahead of themselves in terms of likely earnings. I still believe we're going to have a recession. How much of that is priced in, I don't know, but it's something we are well aware of. And so when you put it all together, it's very hard to have, in my mind, a constructive or positive view on equities at this moment. I don't want to sound like I'm a perma-bear. I don't want to sound like I think the world is ending. But I think, and I'm an optimist, and I'd love to have hope. And I have hope, but I don't have solid evidence to back up hope at this moment.
Maybe an optimistic holder of cash.
Yeah, there's nothing wrong with holding cash.
Exactly.
Nothing wrong with it.